Hello and welcome to the final lesson of this value investing course. We started the course by answering what value investing is and why many investors lose money on the stock market. We then moved on to the topic of intrinsic value and risk minimization. Next, you learned about financial statements, and finally, we discussed how to find and analyze interesting stocks. You've done a great job so far and are almost ready to start managing your own portfolio. And managing your own portfolio happens to be the topic of this lesson. Without further ado, let's get started. By now you should have a pretty good understanding of the value investing philosophy of buying good companies at bargain prices and why this strategy works so well. However, most of what you learned so far was focused on buying and selling individual stocks, while you will most likely be owning more than just one single stock. You will be owning a portfolio consisting of several stocks at the same time. In order to maintain a healthy portfolio, there are 8 portfolio management tips you should keep in mind. The first tip: diversify. This means that you should buy a mix of companies which operate in different industries. This is important because if something goes wrong with one particular industry, only a part of your portfolio will be affected. This way you spread the overall risk of your portfolio. However, we already discussed in the module about risk that too much diversification can be detrimental to your returns. Therefore, I suggest a focused portfolio of 10 great stocks or less. This also allows you to become an expert on each of the companies you own, which enables you to make better informed investment decisions. Tip 2. Keep some liquidity. It might seem counterintuitive to hold on to cash, because cash does not earn you any money. Cash only earns you money when you invest it. Still, having some cash gives you the flexibility to act when new opportunities arise. For example, I was fully invested right before the financial crisis. The stock market dropped, and so did the value of my portfolio. I saw all these great companies trading at bargain prices and wanted to buy them all. But there was one small problem. I couldn't buy any of them because all my cash was already invested. It made no sense to sell my current holdings at a loss because I still believed they would make me money eventually, and they did. However, I could have earned much more if I had had some cash left to invest at the moment of maximum pessimism. Don't be afraid to hold on to some cash, especially if you are unable to find any great investment opportunities. Charlie Munger said it best: "It takes character to sit here with all this cash and do nothing. I didn't get to where I am by going after mediocre opportunities." Tip number 3. Re-evaluate. The world is constantly in motion. Things change. So after you have purchased a stock, you should regularly re-evaluate your current holdings to see if it is still a good idea to keep them in your portfolio. At least once every quarter, analyze the stocks you already own and check if the reason for owning them is still valid. Is the underlying company still profitable and financially healthy? Is the stock still significantly undervalued, or are there better opportunities out there? Did new information appear which could negatively affect the future performance of the company? In other words, regularly check if there are reasons to sell some of your stocks, as we discussed in the previous lesson. Number 4. Minimize trading. Throughout this course, we repeated several times that it is impossible to time the market. That's right, not even you are able to predict when a stock is going up or down in the short run. So do your research and buy for the long run. This way you minimize the amount of trades that you make and therefore the amount of transaction costs you'll have to pay. Because remember, transaction costs are the silent killer of portfolio returns. Tip number 5. Average down. Again, it is impossible to time the market, and so you never know when a stock price has hit its bottom. Instead, buy stocks when they are trading at a significant discount to their intrinsic value, and purchase more when the stock price declines further. This way you can average down, which means you'll reduce your average purchase price by buying more stocks when prices decline. Therefore, you should never buy a full position at once. Also, do not use stop-loss orders, because they limit your ability to average down, as we discussed in lesson 10. 6. Keep adding money. Small amounts can really add up over time. Therefore, I suggest you automatically transfer a certain part of your income to your investment account at the beginning of each month. This way your portfolio keeps growing, and so will your returns. If you transfer the money at the beginning of the month, you probably won't even miss it. However, if you wait till the end of the month, you will probably have spent it already and have no money left to transfer. Also, set up automatic transfers so you won't ever forget it. However, never ever invest money which you might need in the near future or which you have borrowed. Only invest money you can do without for the next 5 years or so. 7. Stick to it. Value investing works. It is no coincidence that the best investors in the world all use this strategy. So stick to it, in good times and bad times, because value investing is a long-term strategy. It will not work if you give up too soon. Sure, you might experience several years of underperformance, but do not ever let this discourage you, because in the end, a strategy of consistently buying great companies at bargain prices wins out over all other strategies. Keep this quote from Buffett in mind. You are neither right nor wrong because other people agree with you. You are right because your facts are right and your reasoning is right. That's the only thing that makes you right. And if your facts and reasoning are right, you don't have to worry about anybody else. The investment checklist, which is part of this module, might help you to stay on track. The final tip is probably the hardest one. Be patient. If you have done your research well and managed to purchase a great company trading at a bargain price, all you have to do is be patient and wait for the stock price to rise to its intrinsic value. Yes, it could take up to several years before this finally happens, but the company's value will probably also have risen in the meantime. This is what makes great companies so great. They create value for you over time. Sitting still and doing nothing is often the best thing you can do as an investor. So be patient and let the power of compounding work in your favor. As Warren Buffett said, that time is the friend of the wonderful company and the enemy of the mediocre. To summarize, there are several important factors you should consider when it comes to managing your portfolio. Diversify by buying a mix of companies which operate in different industries to spread the risk of your portfolio. Always keep some liquidity so you can act when new opportunities arise. Regularly re-evaluate your current holdings to see if it is still a good idea to keep them in your portfolio. Minimize the amount of trades you make to minimize the amount of transaction costs you'll have to pay. Don't buy a full position at once, but instead average down by buying more stocks as prices decline. Keep adding money to your portfolio by automatically transferring a percentage of your monthly income to your investment account at the beginning of each month. Don't give up too quickly. The results will come in time if you just stick to the strategy. Finally, be patient, because time is a friend of the value investor, because it unleashes the incredible power of compounding. That was it. Finito. You made it to the end. Good job. You are now way ahead of most investors. I literally shared everything I know about value investing with you. Now you are able to manage your own portfolio with confidence and start earning amazing returns on the stock market. So start practicing with your own virtual portfolio to gain some experience. And when you feel ready, open a brokerage account and start investing with real money. If you stick to the value investment strategy outlined in this course, I can promise you that when you look back in a couple of years, you'll be amazed by how much your portfolio has grown. It was an absolute honor to teach you this course. Thanks so much for your trust and commitment. If you haven't done so already, please leave me an honest review on Udemy, because I'm very curious to hear what you think about this course. I am your teacher, Nick Kraakman, and I wish you an amazing day.